Hello everyone, welcome to my YouTube channel, Balanced Finance. This is my very first YouTube video ever in the history of anything, so bear with me. My name is Connor, and in this video, I'm going to talk about dividend stocks. Should you consider them for your personal investment portfolio? The answer is yes, but it's important to remember that any investment can be a good investment as long as you have an action plan ready and are working with a licensed financial advisor. This video is going to be cut up into two parts. Here are some key points in today's discussion. What are dividend stocks? What type of trader invests into dividend stocks? What are some typical worries when investing into dividend stocks? Why do companies even offer dividend stocks? And then on the other hand, why companies do not offer dividend stocks? What is the most stable method to research companies that offer dividend stocks? Do they work well with your personal trading strategy? And then finally, what to avoid. So first things first, what is a dividend stock? A dividend is a share of a company's profits distributed to shareholders, and they are usually paid quarterly, like a bonus to investors every 4 months. Dividends are a way for shareholders to greatly increase the opportunity to participate and share in a company's growth above and beyond that of the share price's appreciation alone. This sharing of the wealth can come in one of two forms, cash dividends or stock dividends. Currently, the group of dividend stocks in the US market are dominated by the cash dividends, as opposed to the latter. Cash dividends are simply cash payments made to investors on a per-share basis. I'll give you an example. Suppose you hold 200 shares of a company that offers a 20-cent per share dividend and is on the quarterly payment structure. In essence, you would be accruing $40 on the monthly basis, and on payout after the 4-month period, you would be receiving a payment of $160. The basic action plan is simple, and though the payout doesn't sound like much now, you have to remember that investing into dividends is a long-term endeavor. You didn't have all this money beforehand, and dividends just add to themselves. And so long as you don't cash out those shares, or the company restructures the way that they offer their stock to the market, you'll continue amassing $160 on a quarterly basis. Another common action investors regularly do is reinvest those dividend payments right back to where they came from. And those new shares will inevitably also pay a dividend. You gotta think big picture here. Oftentimes, investors that commit to maintaining certain positions in stocks that offer dividend payments end up snowballing and begin building real wealth. The best part is, this money will constantly and reliably be working to compound itself as long as things stay the same with the company. It is very important to be well involved and up to date with any news or upcoming decisions in regards to the company you're invested into. They have the right to restructure or completely stop offering dividends altogether. This doesn't happen very often, however, nobody likes to get caught with their pants down, so you have to be aware and be attentive with these things. Let's quickly point out what separates special dividends from preferred dividends. While no dividends are guaranteed, some take precedence over others. Shareholders who hold preferred stock have a higher claim on a company's assets than common shareholders, but a lower claim than the bondholders. If a company is forced to cut its dividends, it starts from the bottom of the hierarchy and then works its way upward. It'll pay bondholders first, then it'll pay preferred shareholders, and if there's anything left over, then they will pay the common stockholders their due. Companies use this same hierarchical process when deciding how to allocate capital in good times too. They'll often pay preferred shareholders first and give them a larger dividend than the common shareholders. Another type of dividend is the special dividend. Special dividends are like bonuses on top of your dividend paycheck. They're a one-time dividend payment a company may make after a particularly good quarter, or if it wants to change its financial structure. These extra dividends tend to be made in cash and are often larger than regular dividend payments. As for the type of trader who invests into dividends, whether someone is a day trader or a set-it-and-forget-it type of retirement-focused trader, it is widely accepted that having dividend stocks as a part of your trading strategy is a good decision. If you're skeptical about this, a 2019 Hartford Funds study showed that $10,000 invested into the 500 stock index in 1960 would have generated $460,095, excluding the effect of dividends. But after dividends were factored into this, they would have generated $2.571 million once the dividends were reinvested. Dividend stock take their place well in every portfolio, no matter the investor's age or financial circumstances. It's generally a good idea to include them. The more dividends you reinvest, the more shares you own, and the more shares you own, the larger your future dividends will be. Dividend reinvestment plans automate this process, but keep in mind that Uncle Sam will always get his too. So even if you reinvest your dividends, they are still taxed the year that you receive them. Why would a company offer a dividend stock? It's usually viewed positively when companies offer a dividend payment. Reason being is that dividends are typically paid with money left over from expenses. So this indicates to the investor that the company is financially healthy. This is also the reason that the majority of companies that offer a dividend payment have been around for a while and they are matured companies. The other side of this could be a strong indication of why some companies do not offer a dividend payment. For young and rapidly growing companies, they would be remittent if they could not find a better way to allocate any extra expenditure that would help secure their future. Keep in mind, dividends are not without risk. Rule of thumb is to always seek out advice from a licensed financial advisor before committing to a long-term strategy. Financial advisors study the throes of the market on a day in and day out basis, so they know which sectors are underperforming or overvalued, and will guide you through the risks, taking some of that stress from you. Some common risk areas to avoid are dividend offerings from companies that are linked to commodities or companies that experience cyclical profits and cash flow. This could potentially put this company into a situation where they can't afford to pay their investors a dividend because whichever commodity they are built around is currently out of season. Another risk is a company that holds too much debt. Too much debt means that this company's cash flow is controlled by bondholders. An interest payment to bondholders is mandatory. A shareholder's dividend is optional. You have to remember this. In hard times, these firms could cut their dividends to avoid defaulting on their bond payments. So let's move on to searching for the right dividend stock. A common starting point for choosing these investments is the dividend yield, or the annual dividend per share divided by the share price. The yield measures how much income investors receive for each dollar invested into the stock. For example, a stock trading at $100 per share and paying a $3 dividend would have a 3% dividend yield, giving you 3 cents in income for each dollar you invest at the $100 share price. Investors often think of the dividend as separate from the ups and the downs of the stock market, but actually, they are more connected than people realize. The dividend yield and share price move in opposite directions. If the share price falls, as it often does when a company is in financial trouble, the dividend yield will rise. Investors looking at the dividend yield alone could miss the big picture. This is known as total return, or the increase in share price and paid dividends. To find companies that are good total return prospects, investors should consider what enables a company's business to grow so that its dividend will too. Okay, I know this is a lot to take in. Trust me, this is a lot to say as well. Feel free to rewind the video back and listen for information that you might have missed. Don't be discouraged if this feels like a lot of information, because it totally is. The bright side is that becoming knowledgeable in these topics will only have improvements to your life. Please like the video if you found it of value and comment below any of your feedback or criticism. Nobody is perfect, and I hope that creating this channel, we can build a community where we all learn from each other. Each one of you are valuable, and I appreciate you for watching.